The yen hadn't been worth this little since Ronald Reagan was in the White House nearly 40 years, since a dollar bought as many yen as it does today. No earthquake, no war, no banking collapse explained this drop. It was, simply, the currency of one of the largest economies on the planet losing value month after month without stopping. And then the US government stepped into the market and bought yen, another country's currency, in a joint operation with Tokyo, announced and publicly owned by both sides. Why would the United States spend public money to defend another country's currency? And why should that matter to you, even if you've never bought a single yen in your life? And the answer starts long before Washington entered this story. Before the United States needed to defend the yen, Japan itself was already fighting to keep its own currency from sinking.
The yen surge following a rare U.S. Japan joint yen buying intervention is already losing steam.
They have a weakening yen, and they wanted a little bit of help, and Japan's been very good to us, with the exception, of course, of Pearl Harbor.
The core answer is simple to state, even if complex to fix. The Bank of Japan kept interest rates extremely low for years, while the rest of the world, the United States leading the way, raised theirs. That gap had never been a problem as long as everyone else also had low rates. Once that stopped being true, money started fleeing the yen in search of returns elsewhere. The bigger that interest rate gap between the two countries, the more attractive it becomes to exit the yen and move into dollar-denominated assets, a move that's simple to understand but hard to contain because it feeds on its own momentum. The more people sell yen, the more the yen falls, and the more attractive it becomes to sell even more. The severity of the problem didn't come from alarmist outside analysts. It was Japan's own Ministry of Finance that described the situation as excessive volatility and disorderly moves. The very authority responsible for defending the currency admitting publicly, on the Thursday before the intervention, the dollar hit its highest level against the yen in nearly 4 decades. That might sound like just a financial market number, but Japan imports much of what it consumes, from fuel to food. A weaker yen means all of that gets more expensive, pushing inflation up in exactly the country that had spent decades trying to do the opposite, get prices to rise a little faster. But something even more dangerous was happening. The yen wasn't just losing value. It was making life itself more expensive for a country that depends heavily on imports for energy, food, and raw materials. And the timing didn't help. The yen's decline was further exacerbated by rising energy costs driven by the Iran war, and Japan, with no oil of its own, feels that kind of shock twice as hard. It pays more per barrel, and it pays even more because its own currency buys less with every barrel purchased. In other words, two problems were pushing in the same direction. At the same time, interest rates too low at home, and external costs rising exactly when the currency could least afford to get any weaker. Japan didn't just sit still. Months earlier, the Bank of Japan had already intervened alone in the market, buying yen to try to contain the slide. It worked for a while. The currency recovered, analysts breathed a sigh of relief. And then, a few months later, the pressure came back, and the yen fell right back toward its previous levels. Currency intervention on its own, though, never fixes the underlying problem. Market analysts summed it up in one line: this kind of action can only buy time. It doesn't change the reason money is fleeing the currency in the first place. Japan had bought itself a pause. It hadn't solved anything, and the story was set up for an almost identical repeat. On the first day of the new round of intervention, the yen rallied on a scale similar to what was seen in that earlier solo attempt, the same short-term relief, following the same script. Japan was spending public resources to fight the symptom, without being able to touch the cause. The interest rate gap pushing money out of the yen was still there, intact, waiting for the next window to act again. It was in this context that the U.S. Treasury entered the picture. And here's a technical detail almost no one notices. The operation didn't happen the obvious way. The New York Federal Reserve bought the yen using euros from its own reserves through private banks. But what really matters here is something else. The United States participated directly, with its own money, in a decision that until then had been Japan's alone. Before that, the Treasury had already put banks on alert for a possible future action. The public confirmation came just days later. Japan's finance ministry confirmed the joint action and stated that the two countries will not hesitate to take further coordinated interventions in the future. The White House called it a signal of friendship between the two countries, a helping hand that Japan had asked for, and that the United States decided to grant. The market effect was immediate. The yen strengthened as soon as the intervention and the public confirmation became known. Here's the twist that most simple explanations miss. A signal of friendship isn't, on its own, reason enough for the American government to spend public money defending another country's currency. There's a more concrete reason, and it has to do with the U.S. financial system itself. The yen has for decades been the favorite currency of the so-called carry trade. Investors borrow in yen, taking advantage of Japan's near-zero interest rates, and use that money to buy assets that pay much higher returns in the United States, including U.S. government bonds. As long as that interest rate gap stays stable, the trade can look almost too easy. But if the yen moves too fast, that mechanism cracks. The yen-denominated debt becomes expensive to service overnight, forcing everyone to unwind their positions at the same time and dragging down markets worldwide, including the American one. The risk of an unstable yen was never confined to Japan. It's a risk to the financial stability of any economy connected to it, the United States included. And virtually every major economy is connected to it, one way or another. And that connection reaches closer to you than it seems. Pension funds, investment funds, and even benchmark interest rates around the world depend, to some degree, on the stability of that same currency market. When the yen carry trade cracks, the tremor doesn't stay confined to Tokyo or Washington. It spreads through any investment portfolio exposed to global markets, even if whoever manages it has never heard of the yen. But a weak yen isn't a loose, standalone piece. It's tied to a problem that's already structural: Japan's public debt. With debt above 200% of GDP, the Japanese government has limited room to simply raise interest rates and defend its currency. The most direct way possible, raising rates also makes the cost of rolling over that enormous debt more expensive. The signs of that tension are already showing up in the bond market. The yield on Japan's 10-year government bonds hit its highest level since 1996. That means that even with the currency intervention, Japan is being squeezed from both sides: a weak currency pushing inflation up, and a massive debt, limiting how much the Bank of Japan can respond by raising rates without worsening its own fiscal position. Given all this, there's a question the market started asking almost immediately: can this joint intervention actually change the game? The short answer is no. The intervention contained the immediate panic, but it didn't touch the cause of the problem. Skepticism came fast, and the decision to buy yen raised more doubts than assurances, a sign that Washington's own economic policy is becoming more unpredictable. The uncomfortable truth is that currency intervention buys temporary relief. It doesn't buy a solution. Because, at bottom, Japan is caught between two tools that cancel each other out. Low rates save the debt and sink the currency. High rates save the currency and sink the debt. Buying yen directly avoids having to choose between the two damages right now. It just doesn't solve either of them later. It only pushes the bill further down the road, exactly as Japan has been doing for decades. And there's a development that makes this bet even riskier. Japanese investors have already started repatriating capital to chase higher rates back home, selling $29.6 billion in U.S. debt in the first quarter of 2026 alone. If a prolonged defense of the yen requires even more of these sales, the problem could cross the Pacific. More U.S. treasuries hitting the market pressures their prices, and in turn, U.S. interest rates themselves. In practice, in trying to stabilize its own currency, Tokyo could end up passing some of that pressure on to the American market. The window to find a real way out is closing. It was the first time in almost 3 decades that Washington and Tokyo decided, together and publicly, to buy the same currency, a gesture rare enough to make news in any market in the world. But acting on the exchange rate is treating the symptom while the disease is still there. The United States didn't enter this story out of generosity, but out of self-preservation. Because in a globalized market, when the machinery holding up the yen starts to crack, the tremor doesn't stay confined to Tokyo. It reaches your own pocket, whether you hold yen or not. If you enjoyed this video, follow the channel for more content like this. And tell me in the comments, Will this intervention buy Japan enough breathing room to find a real way out, or is it just another pause before the next drop?